everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 389 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about retirement. This whole episode is really going to be based on if you have recently retired, if you're somebody who has retired and you haven't worked through a market downturn in a substantial way yet, then I think this is something you really need to listen to. And even if you aren't on the verge of retirement and you just want to learn more about how to deal with a down stock market and your retirement nest egg, then this episode would be perfect for you and really help you to kind of have a good idea as to what you are going to do in your investing life when and if the market is to drop as it has recently. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things that I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, I don't know about you guys, but I look forward to the things that I'm going to be able to do one of these days when I retire, right? You may say, well, enjoy your life, Dylan, right? Like, don't just be looking forward to retirement. That's a long way away. I totally agree, right? I agree that retirement is a long way away and that's not something I need to be thinking about. And but we all look forward to that day when we don't have any other responsibility other than, living off of the money that we've built up and being able to do the things that we want to do whenever we want to do them. And a lot of it is the whenever you want to do it and not being beholden to having a job in a traditional way. Now, that's great. And I hope that many of you are in that place. And I hope many of you are working to become financially free to where you can be in that place and you can rely on the nest egg that you have built. But some of you who are about to retire, have retired recently, and when I say recently, maybe even in the past year and a half or so, right? There's something occurring right now that's impacting you or that has the potential to impact you. And impacts you in a very real way. And that's the fact that the stock market is going down and going down quite precipitously, right? Even the S&P 500 right now is down 8.31%. And that was as of Friday's close, right? I just want to give you on a week by week basis. But as of last Friday's close, it was down 8.31% year to date, right? I don't know what it is as of today, but that's not insignificant, right? We're pushing towards correction territory. We didn't get down this much at all last year. So if you retired last year, you never saw the stock market go down this much at one time, right? And then if you're invested in the NASDAQ or tech stocks or whatever, then you're down even more than this, right? So this is going on right now, and this is going on in the same kind of backdrop where inflation is high and you have bond yields that are rising, right? And interest rates that are rising. And if you don't know what that means, I'll just kind of break this down for you real quick. So when bond yields go up, right, interest rates go up, then the price of bonds declines, okay? And the reason that that's the case is because the return that you get on a bond is based both on the coupon payments that are made to you, the interest payments that are made to you, and the change in price over time, right? And then the yield is the return that you're going to make on that bond, which includes both of those two aspects of return. So if the yields are rising, right, interest rates are rising, right, then the price of the bond is subsequently going to decline because that means that the coupon, the amount of interest that you're getting paid is not going to change, right? So the only way that you get a higher yield is if the price of the bond increases more over time. So prices of bonds drop as yields rise, right? And then the inverse is true as well. Now, why is this a problem for you And why does this matter if you are in retirement? Because a lot of retirees have a relatively high bond allocation relative to other investors, right? And your bond allocation, as rates continue to rise, yes, you'll make whatever interest payments there are on those bonds or on those bond funds or whatever, but the prices of bonds will be declining. As a group, the prices of bonds will be declining, right? And then you have inflation, right? So prices of bonds are declining. You've got inflation, okay? So are your bonds even keeping up with inflation in the first place? That's difficult enough. And then you have to think about your whole portfolio. Is your whole portfolio keeping up with inflation? Bond prices decreasing, so that's a decline in the value of your portfolio, right? Inflation's high, which decreases the real value of your portfolio, meaning the purchasing power, how much you can purchase with the amount of money that you have in your portfolio. And then the stock market's down, right? Which means that the value of your portfolio is declined, right? Or is declining or has declined. So what do you do, right? What's the, and I don't want to scare any of you guys, right? I don't want this to be fear, and I don't want this to be me trying to provoke you into action in any type of way. I don't, right? But I want you to be thoughtful, right, about this particular place that you're in. Because if you have recently retired, then it may be a reality for you that the market dropping or the value of your investments being lower or inflation being higher puts a drag on your ability to do what you want to do in retirement, right? There's no doubt that that can 100% be the case. And as the stock market decline may continue, and as rates may increase in the near future, then we'll see this even more. And if inflation persists, then you'll see this even more, right? And so this is a problem. And this is a problem that a lot of retirees don't want to have, and they pray that they don't have. But it's something that you must prepare for because it is real and it is the moment that we are currently in. Now, could the stock market reverse tomorrow? Sure. Could inflation drop in the near future? Of course, right? Now, I think rates are going to continue to rise, and that'll put a drag on bonds for some time, but that isn't going to continue forever either, right? So all of these things aren't going to be things that persist into infinity, right? But they are things that are occurring right now, or that may continue occurring into the near future, that can have a very profound impact. Because if you take very substantial losses in your portfolio early on in retirement, it can be a big problem. Because think about what you're doing in retirement. In retirement, you are taking money out of your portfolio in order to live on it. Okay, you're taking money from here, you're consuming it. Okay, well, if you're taking money out and consuming it, and the value of the investments within your portfolio is declining, right, then it's a double whammy, right? And then next month, you're going to take money out of your portfolio again. And then what if your portfolio has declined even more? Or let's say your portfolio turns around and starts to go back upward, but it's going upward from a lower number because you took it out and it declined, right? You took the money out and the portfolio declined in value. So that is problematic. And it can really put a drag on your portfolio, and potentially, and this is not 100% likely, and it's not, if you've planned well, this shouldn't happen, right? But it can potentially put you in a place where you aren't able to have enough money to live on over a long period of time. And that's not what we want, right? I don't want you to be in that place. I want you to be able to combat this particular risk in your portfolio. But you have to understand first that this risk is real, okay? Now, combating this risk, a lot of combating this risk occurs before you ever are to, be retired. And so this is an episode that I did recently, and I think you guys should go check it out. And it was called "Don't Outlive Your Money," right? And that's what I'm telling you here, right? I don't want you to outlive your money. And so I tell you to do a lot of things, right? Putting a substantial amount of money away for retirement, right? Investing in tax advantaged accounts, paying attention to how much money's coming out of your check in order to go into your investing accounts, having cash reserves, emergency funds, knowing how much money you'll need in retirement, considering staying in the workforce, using the 4% rule as an estimate as to how much money you can withdraw each year, maybe working with a financial planner, right, to feel more confident in your spending plan. All these things are super useful, right? And they are ways that you can make sure you don't outlive your retirement savings. But I don't necessarily want to just rehash the fact that you don't want to outlive your retirement savings. What I want to talk more about specifically today is, what do you do with your portfolio if this is actually occurring? All those things are things that happen right? And if you haven't done those, right, or aren't doing those, then you're going to be in a place that's difficult already, right? But we want to talk about now. What's going to be best for you right now in order to get to where you want to be? And should you change anything? Should you do anything different? Now, I'll just start with this. The first thing that we cannot do, and I talked about this in an episode earlier this week, is that we can't just fall into selling assets because they've gone down in value, right? That is absolutely not the right thing to do. It's not right to just sell when things go down in value, because ultimately you don't have the ability to time the market, right? You are fighting against too many other investors who know probably a lot more than you do about financial markets and have the ability to time the market better than you do. And how are you going to beat them, right? How are you actually going to be able to beat all these other investors? Because I've seen it time and time again. People freak out. They want to cash out their retirement. Oh, I've got to live on this money, so I just need it to be here and all this type of stuff. And then what? And then 6 months down the road, the market has more than rebounded and they want to get back in, right? I've seen this as an investment advisor. It happens, right? It happens where people they want to try to time things, and admittedly, it does not work, right? So what we can't be doing is selling our assets. Now, we may need to adjust our asset allocation, right? Our asset allocation may not be proper for where we are, and it may not be proper for what we're doing, but I would suggest getting advice on that, right? Work with a financial advisor about your asset allocation, what it may need to be, what it may need to look like, right? Know how much risk you are willing to take, how much volatility you are willing to take in retirement, because yes, it can create some real issues for you, but ultimately, if we're just going to get in this place where we're going to sell, well, then we're just going to have cash to live off of, right? And so let's say you've got $1 million portfolio, right? And every year you're going to need $100,000 off that portfolio on average, right? Well, that's 10 years worth if that money never grows, right? So if you're not invested, you've got 10 years, right? So you better hope you don't live any longer than 10 years, all right? But let's say you've got $1 million portfolio and you need $100,000 a year off of it. And let's say your money grew at 6%. Now, of course, you're taking 10% of your portfolio off that first year, and your money's only going to grow at 6%. So, of course, this money is not going to last in perpetuity, right? So this isn't the ideal situation for your finances, but it would be a situation in which, you could continue to grow your money for a lot longer. So how long would that money last? So we would take that million, right? I'm doing the calculation here. We would take that million, we would take out 100,000, right? And then we would grow that at 6%, okay? So that would leave us with 954,000 after a year. And so we would continue on. So that would last us 15-ish years, right? So about 15 years is how long the money would last if you grew it at 6% and took out $100,000 every year, right? But again, that's not ideal either, right? What's ideal is perpetuity, right? What's ideal is perpetual, withdrawals, being able to take out a certain amount every year and your money continuing to grow. It'd be like, taking out $100,000 off of a $2 million portfolio and then it growing at 6%. And then 15 years from now, you've got more than $2 million sitting in there, right? That is what we ultimately want. So what that tells you is, right, if you don't have enough saved for retirement, right, if you're trying to really stretch the math, you're trying to bet on 10% a year returns, or trying to bet on doing so well in the market, or taking so much money out of your portfolio every single year, that can be a drag on your portfolio when something like what's happening right now is occurring, right? When the market's going down and you have multiple asset classes that are decreasing in value at the same time, then you're going to be put in a place where having more money in your portfolio would be useful. So just think about this for just a minute. If you had let's use this example of a $2 million portfolio versus the $1 million portfolio, right? You have the $1 million portfolio, right? And let's say you take out $100,000 in that first year, and let's say that you lost 5% on your portfolio after that, right? That would put your portfolio value at $855,000. Well, you're still going to need $100,000 every single year. So now that next year, 100,000, right, divided by that 855,000, right? That means that next year you're taking out 11.695% of your portfolio, right? So just to stay at 855,000, you would have to make 11.7% approximately on your portfolio in order to take out that 100,000. But let's say the same thing, right? The same thing occurred in the $2 million portfolio. So now, right, we have this $2 million portfolio. Your portfolio decreases in value by 5% that year, right? Decreases by 5%. We still need 100,000 out of it, right? Guess what? Now, instead of taking 5% of that portfolio, we just need to make 5.54% in order to get the same amount of money, right? So ultimately, having a larger nest egg, having more retirement savings can be super substantial in our ability to maintain our portfolios over time. Because if we're really stretching our ability to take out the amount of money that we want or need every single year or every single month in retirement, then it's going to be problematic and it's going to be hard to have a positive balance in our nest egg over a long period of time. But the bigger the portfolio that we have, right, the less substantial a market correction or a market crash is going to hurt us. Now, you also need to think about this. Regardless of where you're at in retirement, you need to make sure that the amount of money that you are taking out, the amount of money that you do plan to live on, is reasonable, right? Don't try to outkick your coverage because you're sitting around looking and going, hey, I got $2 million in a portfolio, or I got $5 million in a portfolio. Right? You can spend $5 million. I promise you can. And if you don't think you can, then go look at all the athletes that are broke nowadays, right? It's not that hard. It's not that hard to blow that money. So don't think that you can just spend it on whatever or whenever, because you'll look up later and you won't have it, right? You won't have anything left, and then you'll have to worry about Social Security sticking around instead of being able to be self-sufficient in your portfolio, right? This is a position I don't want any of you to be in. I don't want you to be in a position where you have to think too much about the amount of money you're taking out or the amount that you have to make on your money in order to just stay at a consistent level. This is why I tell you to invest so aggressively and prepare so well for retirement, right? Now, how do we combat this risk, right? There are options for mitigating this risk. I've kind of touched on a few of them, but the first is just simply to spend more conservatively, right? The less you spend on a consistent basis, the less you'll have to withdraw. So the less that these market downturns are going to hurt. So again, being realistic with the amount of money that you take off of your account is a huge, huge deal. And if you begin retirement saying, I want $100,000 a year, but then, the market's declining and you say, well, hey, maybe this first year we can live on 75 or 80. That can help you in a very, very real way to not deplete your retirement savings and allow you to, still have what you need. Yes, I 100% believe that in retirement you should plan for wants just like you plan for needs. I agree, right? But at some point you set some wants aside if you must, and just focus on the needs, focus on the more pressing things and what you'll actually need in retirement, and it'll be a lot more beneficial to you. Now, another strategy is just to adjust your spending when the portfolio performance is suffering. And that's kind of what I was suggesting just a moment ago, right? Saying, hey, the market's not too good this year, not looking too good. How about we take out less? That way our portfolio can rebound a bit quicker, right? And that's possible, right? But that's kind of bordering market timing, which becomes quite difficult. So I would just suggest finding a level of spending that is reasonable, like when I was looking at that $2 million portfolio and saying, hey, we're going to take 5% out every year. That's not unreasonable. Or if you're going to take 4% out of a portfolio, like the 4% rule, or anything less than that, that's not going to be an unreasonable percentage to take out every year. But if you're banking on taking out 10% a year, that's going to be problematic over a long period of time, especially if you're relying on that money, right? You look at your expenses and you see if there's any that you can stop, right? So maybe you don't take a trip or you delay doing a large renovation that would require a big distribution, right? That's something that you may really need to think about. Also, let's say you're somebody who's going into retirement, right? You're about to enter retirement and you see the market has taken a downturn, and so your portfolio is taking a hit, and there was something you were going to do at the beginning of retirement and take this big distribution. Maybe you don't take that big distribution, or maybe you keep working for just a little while in order for your portfolio to rebound, and then you can retire in better times, right? Not many people have that luxury, but you could absolutely do so. And again, if your portfolio is substantial enough, it's not going to matter. It's not going to matter when you retire. Retire whenever the heck you want to, because you'll still be able to reasonably take out the amount of money that you want to take out every single year, right? Now, you can also actively reduce risk in your portfolio. So for instance, you could have a low stock allocation early in retirement, but increase it over time, or use bonds for short-term expenses and stocks for long-term ones. So I've talked before about this idea of buckets, right? Where you have different buckets of assets, right? You have like cash, you have bonds, and you have stocks, or dividend paying stocks and growth stocks or whatever, right? And so basically you use your more short-term assets in order to pay for what's right ahead of you, right? So have cash to pay for today's expenses, or have shorter term bonds or intermediate term bonds to pay for the next few years' expenses, and then have growth stocks, longer term stocks, whatever, allocated to the point where you can still grow your money over a longer period of time, but have those for more long-term expenses, right? So you reduce volatility strategically, because what do we know? We know that assets, even bonds, right, are going to be more volatile in the short term, and stocks are extremely volatile in the short term, right? And so we're not going to spend our short-term volatile assets. We're going to spend our assets that are less volatile in the short term, cash and bonds, right? And then we will spend over the long term assets that become less volatile the longer that you hold them. And I've told you guys before, based on stocks for the long run, right? Over a long period of time, stocks actually get, like a 30-year period, right? Stocks actually get less volatile than bonds over a 30-year period annualized, right? And so you actually get this better risk-reward relationship there. But you just have to make sure that you're making the returns that you need while strategically reducing volatility in those ways. I think that's a really good thing to try to do, especially if your portfolio is not super huge, right? If you don't have this huge portfolio and you're really having to think through the amount of money that you're having to take out every single month or year for your retirement, I think that's a really good strategy to use. Now, of course, if you have a plenty big portfolio, then this may not be something that you want to mess with. It may be a bit too much work for not too much of a positive outcome. Now, another option is to have assets outside your investment portfolio that can support your spending needs when stocks are underperforming, right? So basically having like an emergency fund for your investments, which I think is also very interesting if you're kind of having to work through this whole idea of, making sure that you have enough money. Because let's say that, you were able to, over time, not just build up a big investment portfolio, but have maybe a year or two worth of expenses in just savings, right? And I'm not suggesting that you have that, but I'm saying maybe that'd be interesting, right? If you had that amount outside and you could just leave it there, and then stocks underperform substantially for some period of time, maybe you can just pull some money out of that to live on until stocks were to rebound, and then you'd be back in the green. You'd be back in the positive and not have to worry so much about your investment portfolio catching up and you taking distributions when it was down. I think that's an interesting thing to do as well, right? You would use this temporary resource while you wait for your portfolio to recover, right? And that buffer, it could be cash. Some people talk about reverse mortgages or lines of credit or permanent life insurance doing that. I don't think that's a good idea. Cash would be the move. Those other things, there's just too much inherent risk associated. Now, additionally, how well the market has generally performed over the last decade. You may simply be able to meet your goals without taking on risk that comes with stocks, right? You could just take some of that volatility off the table, right? You may just be in a place where you can get what you need without having an allocation in stocks. Another thing I want you really to think about, and I talked about it a little bit earlier, but is your asset allocation, because we have to remember that our asset allocation, stocks, bonds, whatever other types of assets, is not just for returns, right? A lot of it is for risk. It's for risk mitigation. Okay. So we have to understand that if we can have a proper asset allocation that'll put us in a place where we can make good returns and decrease risk in a substantial way, then we may be in a perfectly fine situation if the stock market were to decline substantially. So just for example, right, would be Ray Dalio's all-weather portfolio, right, where it's got a very high allocation into long-term bonds, right? It's got only a 30% allocation into stocks. It's got allocations into gold and commodities, and then shorter term bonds and all these different types of things, right? The asset allocation is not what you would expect out of something that would grow at a 7.5% to 8% clip a year, but it has historically done so, and done so with very, very little volatility. So something like that might be something that you think about in order to decrease volatility, still make really good returns, and be able to look at your portfolio and be like, I'm not worried about market downturns as much as someone else, right? But we are in a very unique place where the price of bonds is likely to drop, and the prices of stocks are likely to come back down to earth, maybe even more than they have already. And so it's going to be interesting. It's going to be interesting to see exactly what this looks like for retirees. Hopefully, you've saved up enough money to be where you need to be over a longer period of time. Hopefully, you've got your asset allocation to a point where you're not too reliant on any one asset class and you can continue to grow your money. Hopefully, your expenses are not so much that they're going to, ruin your ability to live a very fulfilling and enjoyable retirement over a long period of time, because that's what I want for you. I want you to have financial freedom. I want you to have options, right? The more money you have in your nest egg, the more options you have, right? Because like I was saying, if you are in a place where you're so worried about the withdrawal rate that you're taking, all this kind of stuff, right? That gives you less options. That gives you less ability to make some decisions based on just, hey, I want to, right? But if you have a bigger nest egg and you don't have to worry so much about those things, then you can have a much more enjoyable retirement and really not stress so much about the money aspect of it all. But the money aspect of it all is very important, and I just want you guys to be understanding that this can have an impact on you. Now, should this impact what you do today or tomorrow? Or no, it should not, right? But if you see this type of trend going on in your portfolio where it's declining in value and you're taking money out, and then you need to be thoughtful about how long your money is actually going to last, and exactly what that should look like. And maybe you do need to get with a financial advisor and talk through your portfolio's allocation and exactly what it would look like to make your portfolio last. And sadly, some people may just need to go back to work and allow themselves time to build up a big enough portfolio. I hope that's not the case for you. I hope that you are in a good financial place to retire when you want to, how you want to. But I know that's not everybody's reality, but guess what? That's okay. I just want you all to get to that point of long-term financial freedom. I want you to all get to the point where you have that success, that enjoyable retirement, that comfortable retirement. And then hopefully you don't have to worry about these things quite as much. So hopefully I help you with this very real risk in the stock market and in your life. And I know this is a little different demographic reaching out to here than I typically would, but everybody needs help. I try to make sure that I can help as many people as possible on this show. And this is something that is very real and very tangible right now. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think can be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.